WSP Global just added over 1.1 billion Canadian dollars in market cap in a single trading session. They absolutely smashed Wall Street consensus estimates across the board for their Q2 2026 earnings report. Total revenue hit 5.4 billion.
Which, easily clears that 4.21 billion estimate we were all looking at.
Exactly. And net revenues came in at 4.27 billion. As for profitability, adjusted earnings per share landed at 2.88, beating the 2.82 consensus.
Right, and management even raised full-year guidance. They're now targeting up to 17 billion in net revenue and 3.18 billion in adjusted EBITDA.
The market obviously loved the beat and raise. Shares jumped over 6.3% the following day to close at 192.56. And this was on massive institutional volume.
Yeah, like 1.6 times the normal daily average.
Yeah.
And this is a massive, if you look past that headline rally, their actual foundational earnings per share, so the GAAP basic number, it actually dropped by nearly 12% down to 1.83.
Right. And that is exactly why we are doing this deep dive today. We need to unpack the operational brilliance that's driving WSP's record-breaking margins, map out exactly where their massive backlog is coming from, and then look closely at that dangerous debt-fueled reality hiding just beneath the surface of their balance sheet.
Because that divergence, the gap between those adjusted and GAAP numbers, that is the entire story of this earnings report.
Yeah, when you look at the adjusted metrics, you see a company with phenomenal operational momentum, right? They're winning massive contracts,
Expanding margins, generating huge top-line growth. But then those statutory GAAP numbers, they reveal this really complex narrative of aggressive M&A expansion.
and severe integration hurdles, plus mounting financial leverage that you as a retail investor really need to understand before buying into this rally.
Absolutely.
So let's pull apart that top-line revenue beat first. When you look at the underlying profitability, you start to see why the market reacted so aggressively.
It wasn't just about WSP bringing in more cash. Investors were reacting to, well, a level of historic efficiency. I mean, adjusted EBITDA surged 28.8% year over year to 815 million Canadian dollars.
And the adjusted EBITDA margin expanded by 90 basis points to hit 19.1%, which, it might sound like a minor uptick to some.
Right, 90 basis points doesn't always sound huge.
But at a scale of $24 billion, almost a full % of margin expansion is a massive amount of extra cash hitting the bottom line.
And management was quick to point out on the call, this is the best Q2 margin in their history as a public company.
Which is wild. They also noted they're now on a clear trajectory to hit their 19% to 20% margin target by 2026.
Yeah, a target that was originally set for 2027 in their strategic plan. Anytime a mega-cap company pulls its long-term strategic profitability targets forward by an entire 12 months, institutional capital is going to flood into the stock.
Right.
They were proving they can scale efficiently.
But logistically, how do you actually turn a ship this massive on a dime? We are talking about a professional services firm with, 84,600 employees?
Yeah, something around there. Huge.
You don't just find 90 basis points of margin hidden in the corporate couch cushions.
No, definitely not.
Expanding margins at that scale, it's like watching a heavy, slow-moving cargo ship suddenly accelerate and maneuver like a speedboat. What is the actual mechanism driving this profitability?
Well, it comes down to a few specific structural shifts. It's not just them raising prices on their clients. They realize specific productivity improvements across their operations in the U.S. and Canada.
Okay, so basic operational tightening.
Partly, yes. And they also benefited from lower optimization and right-sizing costs compared to last year. But the real structural cost advantage, the engine of this speedboat of yours, is their global capability center located in India.
Oh, wow. Yeah, I saw those numbers in the report. They've aggressively scaled that offshore center to 6,500 employees.
Right, which means that group now represents a full 8% of WSP's entire global workforce.
That's a huge jump. Just a short time ago, it was sitting around 5% or 6%. They added a net 1,000 new employees in India just this year alone.
Yeah.
But how does dropping 1,000 employees into a lower-cost geography actually push margins to record highs without disrupting the actual quality of the engineering output?
So it works through this highly integrated 24-hour engineering cycle. They often call it the follow the sun model.
Follow the sun. Okay, how does that actually work in practice?
Let's say a lead architect or a senior engineer in New York finishes the conceptual design work for a new transit system at, 5:00 p.m.
Okay.
Instead of having high-cost North American staff spend the next 3 days doing the intensive CAD drafting, the 3D modeling, and all that administrative data entry.
They just hand that file off to the team in India.
Exactly. The team in India completes all that heavy lifting overnight, and the finished detailed models are waiting in the New York engineer's inbox by 8:00 a.m. the next morning.
So it drastically lowers the blended cost of delivery per project.
Yes, while simultaneously cutting the project timeline in half.
I mean, that is the textbook definition of operational leverage right there.
It really is. As top-line revenue grows, the cost to deliver that incremental revenue just does not rise at the same pace.
And interestingly, CEO Alexandre Leroux specifically noted that while WSP is actively exploring AI tools for their engineers, the massive productivity gains we are seeing right now are still driven primarily by workforce management.
Yeah, it's about scale and intense operating discipline, not necessarily software automation just yet.
So, record margins tell us a lot about their current efficiency, but to justify management raising that full year 2026 guidance, you really have to look at the fuel going into the engine for tomorrow.
Right, you have to look at the backlog.
And WSP posted a record hard backlog of 20.1 billion Canadian dollars. That is up 23% year over year.
Which is massive. It means they have almost a full year of revenue, 11.6 months to be exact, just sitting on the books waiting to be billed.
And buried inside that massive backlog figure is arguably the most important metric for assessing the true health of the business: organic net revenue growth.
Yes, it hit 5% for the quarter. And that organic number accelerated to its strongest pace since 2022.
Which is a huge signal to investors.
It really is, because it tells you that if you completely strip away the massive acquisitions, WSP's core legacy business is still highly competitive. They're capturing significant market demand on their own merits.
So if we break down where that core demand is actually coming from regionally, the Canadian market is clearly firing on all cylinders.
Oh, absolutely. Their defense pipeline doubled.
Yeah, they are now the leading direct provider of engineering and environmental services to Defense Construction Canada.
Right, holding over 25 active master service agreements just there. And nuclear revenue in Canada tripled. Plus, their mining backlog is up 25%.
Mining is up 25%. That's incredible.
Yeah, Canada is currently benefiting from this perfect storm of global capital allocation. Billions of dollars are rushing toward critical minerals, things like copper and lithium.
Which they obviously need to support global electrification and battery supply chains.
Exactly. And WSP has over 5,000 professionals globally dedicated just to mining. It's a highly specialized, high-margin business for them.
And it's averaged double-digit organic growth for 5 years straight, right?
Yeah. So you combine that mining supercycle with the global surge in defense spending and the ongoing renaissance of nuclear power for baseline grid stability.
You quickly realize WSP is positioned directly at the intersection of 3 massive multi-year macro trends.
Now, looking south to the Americas, specifically the U.S. market, the numbers get even larger. WSP reported 10 billion Canadian dollars in sub-backlog for the U.S.
Which is up 9% from just the first quarter.
Right. The power and energy sector is driving a lot of this. Revenue from their top 40 global power clients in the U.S. jumped 15%.
And their data center sales pipeline is up an incredible 30% year over year. I mean, they were recently ranked #1 in data center design by Engineering News Record.
Yeah, and they are currently supporting more than 6 sites that have over 1 gigawatt of compute power capacity.
Okay, wait. To put that in perspective for our listeners, a 1 gigawatt data center is not just a large warehouse filled with server racks.
Oh, no, not at all.
Okay.
You are essentially designing the power consumption footprint of a small city and just, dropping it into a single geographic location.
The engineering complexity required for that has to be staggering.
It is. I mean, you have to design massive thermal cooling systems to keep the AI chips from melting down.
Right.
You have to engineer the high-voltage transmission lines connecting the facility to a broader, often aging power grid.
And you have to navigate years of complex environmental permitting just regarding the water usage for the cooling towers alone.
Exactly. So WSP has actually doubled its client base in this sector to 70 clients over the last year, largely because very few firms have the scale to handle that level of complexity.
The scale is undeniable, but, I want to challenge a specific point management made regarding those U.S. numbers.
Okay, what stood out to you?
Well, they noted that 86% of that massive U.S. sub-backlog sits in what they call framework agreements.
Right, the framework agreements.
From an investor's perspective, a framework agreement sounds like a very polite way of saying you just made it onto a pre-approved vendor list.
That's a fair point.
I mean, it is not a sign-binding contract to build a specific substation today. So how quickly can a framework agreement actually convert into billable hours and real cash flow?
It's a vital distinction to make, and it's something retail investors really need to grasp. A framework agreement or a master service agreement means you have survived a highly rigorous legal and financial vetting process by the client.
Okay.
You've already locked in the overarching pricing structures, the liability limits, the legal terms. So you are absolutely right that it does not guarantee immediate work today.
Right, so where's the value?
The mechanics of utility procurement make these agreements incredibly valuable. WSP currently serves the top 60 investor-owned utilities in the U.S.
That's a huge chunk of the market.
It is. Now, when one of those utilities receives regulatory approval to upgrade a transmission line, they do not want to spend the next 12 months going through a competitive public bidding process.
And negotiating legal terms from scratch with a new engineering firm.
Exactly. So they just bypass the red tape entirely and go straight to their framework partners.
They just issue a task order?
Yep. They simply issue what is called a task order under the existing framework agreement. Because all the heavy legal lifting is already done, that task order converts into billable engineering work with almost zero administrative friction.
Okay, that makes sense. So while sub-backlog is not cash in the bank this afternoon in a rapidly expanding infrastructure market, it functions as this highly visible, incredibly fast-converting revenue pipeline waiting to be tapped.
You got it. It essentially gives WSP a fast pass to the front of the line for billions in utility spending.
Before we leave the regional breakdown, we really have to touch on the APAC region. Management was pretty transparent that Asia-Pacific was a mixed bag.
Yeah, it wasn't all sunshine. Australia is outperforming expectations, but New Zealand remains visibly soft.
Mostly due to a pullback in government transport spending, right?
Correct. It highlights that not every geography is booming right now, but the sheer weight and acceleration of the U.S. and Canadian segments are easily carrying the overall business.
Geographic diversification is sort of the ultimate hedge in the engineering sector, isn't it?
Absolutely. If a firm is too concentrated in one region, a simple change in a local government's budget can just devastate their quarterly earnings. WSP's global footprint protects the broader company from regional soft patches like the one we are seeing in New Zealand.
Which really brings us to the strategy behind building a footprint that large. Earlier, we noted that organic growth was a solid 5%.
Right.
But a massive 17.1% of their total revenue growth came directly from recent acquisitions. WSP's entire business model relies on an incredibly aggressive M&A playbook.
And CEO Alexandre Leroux made no secret of this on the earnings call. His explicit philosophy is that scale matters.
That by becoming an absolute behemoth in the industry, WSP can afford to be highly selective with the clients they take on.
Exactly. They no longer have to fight in the trenches for those smaller, lower-margin municipal projects. They can focus exclusively on winning massive, long-duration, highly complex mandates where margins are fundamentally better.
The primary fuel for this strategy lately has been the acquisitions of TRC companies and Ricardo Plate.
TRC was a huge purchase, and management say the integration is on track to wrap up within the next 6 months.
And TRC's hard backlog is already up 30% year over year. Management even highlighted over 100 specific collaboration opportunities where WSP and TRC teams are actively cross-selling their services.
Yeah, in one case, that cross-selling resulted in a major award from a utility client to support a $78 billion five-year capital plan.
Which gives WSP line of sight to over $10 billion in potential future work.
The TRC acquisition makes perfect strategic sense when you look at what TRC actually does. They are heavily focused on power grids and environmental engineering.
So by acquiring them, WSP basically bought the ultimate toolkit to dominate the U.S. energy transition.
Exactly. And it looks fantastic when you are only looking at top-line revenue growth and cross-selling synergies. But this is exactly where we have to confront that glaring divergence in the earnings report.
Right, the gap between the adjusted EPS and the GAAP basic EPS, this is the crux of the bear case.
It really is.
Adjusted EPS was up 23% to 2.88, but GAAP basic EPS plummeted nearly 12% down to 1.83.
Yeah.
If you are a retail investor looking at your screen, seeing earnings dropping, what is the actual accounting reality driving that GAAP number down so hard?
Well, it exposes the true tangible cost of buying all this growth. Look, adjusted figures are essentially a management-constructed narrative.
They strip out all the messy friction of mergers and acquisitions to show you what the core operating business looks like in a vacuum.
Right, but GAAP accounting forces the company to show you the whole ugly truth of digesting these massive companies. That drop to 1.83 reflects heavy non-cash accounting, like the amortization of the intangible assets they just bought.
What far more importantly, it reflects very real, massive financing costs.
Yes,
Yeah.
because they had to borrow heavily in a higher interest rate environment to afford TRC.
If you look closely at the income statement, net financing expenses spiked to 140.5 million Canadian dollars for the quarter.
Compare that to just 14.6 million in the same quarter last year. That is almost a tenfold increase in financing costs, eating straight into their net income.
Wow.
And this is not a paper loss. This is real cash, leaving the business to service debt.
Furthermore, the actual process of integrating thousands of new employees is incredibly expensive on its own. Management guided that integration and reorganization costs will run between $285 million and $305 million for the full year 2026.
Digesting TRC is severely depressing their statutory earnings today.
So buying top-line growth is clearly straining the balance sheet. WSP's leverage ratio, which measures their net debt against their adjusted EBITDA, currently sits at 2.3 times.
Which is sitting uncomfortably above management's own stated target range of 1.0 to 2.0 times.
The debt they took on for TRC pushed them right over their own safety limit. And this is where the story gets really dramatic.
Right.
Just days before these earnings were released on July 30th, a rival engineering firm named Arcadis unanimously rejected a second unsolicited takeover proposal from WSP.
The offer was for 51.50 euros per share. Now, target companies reject initial buyout offers all the time. But it is why the Arcadis board rejected it that really matters here.
Yeah, Arcadis management publicly stated the offer undervalued their firm, which, is standard.
Very standard.
But then they took a very pointed shot at WSP's balance sheet. They publicly cited WSP's large stock component in the offer, their high financial leverage, and the severe integration risks associated with WSP's strategy as the primary reasons for walking away from the table.
Which is scathing.
Honestly, watching this aggressive M&A strategy play out right now, it feels a bit like watching a competitive eater.
Well, here we go.
No, seriously. WSP just shoved a massive, heavy meal TRC into their mouth. They are visibly struggling to chew and digest it. Their financing costs have spiked tenfold. Their leverage is above target. And integration costs are nearing $300 million.
And instead of pausing to swallow, stabilize, and let the balance sheet recover, they immediately reached across the table with both hands to grab the next massive plate in Arcadis.
Exactly. Is this company at risk of severe financial indigestion?
The broader market is absolutely asking that question. The Arcadis rejection is a material validation of the bear thesis against WSP.
Because when a target company's board publicly points to your leverage and integration risks as the specific reasons they refuse to merge with you, it signals that the industry is deeply aware of WSP's execution risks.
It is essentially the Arcadis board looking at the offer, realizing half the deal will be paid in WSP shares, and telling their own shareholders, we cannot accept this stock as payment. Their equity carries way too much debt risk for us.
That is exactly what happened. Arcadis explicitly stated that taking WSP paper represented a materially different risk profile. They cited significantly higher than anticipated leverage and a lower than expected dividend yield.
To have a peer company publicly bash your equity as too risky is a major red flag that retail investors cannot ignore, regardless of how much the stock rallied on the earnings beat.
So if you are an investor holding WSP in your portfolio right now, you really have to weigh these competing realities.
Yeah, the stock rallied 6.3%. The margins are undeniably historic. The organic growth proves the core business is incredibly healthy.
But there are underlying warning lights flashing. Independent analyst models, suggest the stock might actually be overvalued compared to its fair value estimate.
And 5 separate analysts recently revised their earnings expectations downward for the upcoming period.
Plus, it is worth remembering that before this massive post-earnings spike, WSP had actually suffered a negative 29% total shareholder return over the previous 12 months.
So the takeaway for you as an investor is that while the underlying engineering operations are executing brilliantly, the financial engineering at the corporate level is reaching a tipping point.
Management made a firm promise to the market to return that leverage ratio back down to the target range of 1.0 to 2.0 times by the end of this year.
That is now the single most critical metric to monitor. Investors also need to keep an eye on their days sales outstanding, or DSO, which ticked up to 71 days from 69 days a year ago.
Right, which indicates it is taking slightly longer to convert those massive billings into actual cash flow.
If they fail to delever the balance sheet as promised, or if they recklessly pursue another massive debt-funded acquisition before fully stabilizing TRC, The market's patience with that massive gap between adjusted EPS and GAAP EPS will eventually evaporate.
We are basically watching a phenomenal, highly efficient speedboat that is currently dragging a massive, heavy anchor of corporate debt.
That's a great way to put it.
As we wrap up our deep dive today, you have to ask yourself a longer-term question. With the undeniable rise of artificial intelligence and the massive global grid expansions required to power these 1 gigawatt data centers, WSP's specific engineering expertise has never been more vital to the global economy.
The structural demand is absolutely there.
But if macroeconomic conditions begin to cool down, interest rates remain elevated, and public infrastructure spending tightens, will WSP's aggressive debt-fueled acquisition strategy become an anchor that ultimately sinks an otherwise stellar underlying business?
Balancing the brilliant operational execution against the mounting financial risk is the multi-billion-dollar question that will dictate this stock's performance over the next 12 months.
The tension between those two forces is going to be fascinating to watch play out. Make sure you follow the show for daily, no-nonsense earnings coverage just like this. We break down the filings and connect the dots so you don't have to. We'll see you on the next deep dive.